Hey, so we are in Midtown Manhattan with the one and only Tony Robbins. Unshakeable is coming out, your new book.
Yes.
What I loved about the book, because I flagged it, I got the galley, and here's all my little flags,
Cool.
is you are unshakable. And to me, I think that's what you want people to be when it comes to making financial decisions.
Yeah, a decision made from fear in the financial world is almost always the wrong decision. And that book was designed so if you're a billionaire, you get the value because you got the best from all the billionaires, or if you're a person just starting the journey but is big. And so I thought, I want to write a short book somebody could read in 4 hours, but I also want to write one because there's so much fear right now. So the idea of, let me get out of the market because it's scary, I want to show people the truth in this book and show them also that this is maybe one of the few opportunities in their life to leapfrog from where they are now financially to where they want to be. Because when things crash, when they go, it's really the market going on sale. And so what I wanted to do is guide people through a game plan. You have nothing to fear, and here's how you can take advantage of what's coming. That's what'll make you unshakable, not being positive, not being confident, knowing the facts. And when I interviewed the richest financial investors in the face of the earth, they had a lot of things in common. One was they're obsessed with not losing money,
right?
Which sounds, simplistic, but the average investor is all trying to make money. Second thing they're obsessed with is asymmetrical risk reward. How do I take the least risk to get the biggest reward? The average investor is thinking, if I want huge rewards, I got to take huge risks. Oh, do I do this? Right? And that's a recipe for disaster. These guys are saying, Paul Tudor Jones is saying, how do I risk $1 to make 5? And if I'm wrong, I can risk another $1 and still make a lot of money. I can be wrong 4 times and break even. That's how these guys think. The third one is tax efficiency.
Right.
Because when I was asking David Swenson from Yale, he took Yale. It took him 200 years at Yale to get a $1 billion endowment. He turned it to $25 billion in 2 decades. And I was digging in how he did. He shared with me all the ways. I put it in the book. But one thing he said to me, Tony, is I couldn't have done it if it wasn't for the fact that we're tax efficient here because they're a nonprofit organization. Because he goes, watch this. You know compounding. $1 doubled is 2. Double again, it's 4, 8. 20 doublings of $1 is $1,048,000. But if you pay 33% tax each year, which you and I and most people watching pay a lot more than 33% of tax all in.
Yeah.
But if we were lucky enough to do that, do you know how much money you have at the end? You have $28,000.
Oh my God.
That's the impact of compounding fees or taxes. So you have to be smart on your tax efficiency. But if you start with that, you made a big mistake. Like in the 70s, people were looking for tax cuts. You got to find investment where you're not going to lose money because you got enough diversification, you got the right asset allocation. You've got to make sure that you've got something that's asymmetrical risk reward or the best you can. And then you look for tax efficiency. And then the last one is diversification,
right,
which we all know because that's the only free lunch. And it's diversification of assets. Within assets, you don't want all your things in one piece of real estate.
Right.
It's across different markets in the world and it's across time. Those are the only four things that all people had in common because some are macro traders, some are like Sir John Templeton, I interviewed before he died, blood in the street guys,
Yes,
maximum
yes.
pessimism. All of them are different, but they all have these same 4 qualities, whether you're talking to Carl Icahn or Ray Dalio or Warren Buffett.